Chapter 17, pensions. We begin with net periodic pension cost. The projected benefit obligation, or PBO, reflects future compensation levels, whereas the accumulated benefit obligation is the present value of pension benefits accrued based on present compensation levels. So what's the takeaway there? The projected benefit obligation reflects future compensation levels, whereas the accumulated benefit obligation reflects present compensation levels. And our handy little acronym for net periodic pension cost is PRIUS, because someday when you're old and retired and you want to do your part to save the environment, you're going to buy a Prius, right? Never mind the fact that electric cars are powered by electricity, which are powered by coal. But anyway, that's another topic for another day. And I try to never get political, so forgive me. All right. So, net periodic pension cost, PRIUS. You have prior service cost amortization minus return on plan assets plus interest plus unexpected loss or gains plus service cost. So PRIUS, you have prior, return, interest, unexpected, service, PRIUS. Prior service cost amortization minus the return on plan assets. So that makes sense because as your plan assets generate a return, well, you're going to have less periodic pension cost. So the company isn't on the hook for as much. Plus interest, plus any unexpected loss, plus service cost. So prior service cost amortization minus return on plan assets, and that's estimated, plus interest, plus unexpected loss, plus service cost. So the only aspect of this, so to keep the plus and minuses straight, the only thing that is a minus here, the only thing that reduces your net periodic pension cost is the return on plan assets. Because it's as you put the money in the market and it generates money, you have less periodic pension cost. And so prior service cost amortization, return on plan assets, then you have interest. So you have the beginning projected benefit obligation times the interest rate, and then the increase of the projected benefit obligation over time. So that's the interest component. And then you have your unexpected losses or gains. And obviously if it was a gain, if you had an unexpected gain, then it would be a negative. It would reduce your net periodic pension cost. And then finally you have service cost, because as employees work, as they continue to go to work, then your projected benefit obligation as the company, it increases. Now, one thing that you need to know for service cost is the only component of net periodic pension cost that's allowed as an operating expense on the income statement. So that makes it special. So all of that together gives you net periodic pension cost. Fair value of plan assets, the PBO, projected benefit obligation. If it's overfunded, it's an asset and it's non-current. If it's underfunded, it's a liability, and it's current and non-current. And any gains or losses go to other comprehensive income, net of tax. And there are some financial statement disclosures. You need to disclose your pension funding policies, the types of assets held, 5-year benefits to be paid, and then 5-year benefits in aggregate after that, and the estimated pension contribution for the next period. Vested benefits. These are owed to employees regardless of continuance of employment as of the full eligibility date. I hope this sheds some light on pensions, and it's kind of a tricky topic. I would listen to this chapter again. Again, remember your Prius, prior service cost amortization, return on plan assets. That's the only negative, because your plan assets make money, you have to pay less. Your plan assets are working for you as an asset. Then you have your interest, so the projected benefit obligation. You increase your interest cost due to time. And then any unexpected losses, or if you have an unexpected gain, it's actually negative because it helped you, then your service cost. So I hope this has been helpful. This concludes Chapter 17.